The credit behind America's boat market is failing at a pace lenders have not seen since 2008. Tommy's Boats ran 14 dealerships across 8 states. It stopped paying M&T Bank on $105 million of floor plan debt, and the entire chain was liquidated. That was the warning shot. The second crack is aimed at the person holding the retail loan, and the reason has almost nothing to do with how many people still want boats. So, what does that mean for the boat sitting in your slip or on your trailer right now? If you finance somewhere between $30,000 and $200,000 in the last 4 years, the gap between what you still owe and what your boat would actually sell for this weekend is wider today than it was the day you signed the paperwork. Not by a little. On some models, by tens of thousands of dollars. And the machine that widened that gap was never visible to you because it was never built for you to see. On May 17, 2026, West Marine filed for Chapter 11 bankruptcy protection in Delaware. That is the largest marine retailer in the United States, 58 years old, running more than 200 stores across 34 states. The filing listed $549,200,000 in funded debt. 59 of those stores are closing, roughly a quarter of the entire chain, with a liquidation firm brought in to run the sales. Most of that debt was never built by bad trading. It was loaded on in 2017 when a private equity firm bought the company using a leveraged buyout, borrowing against the stores and the inventory, and leaving the company to service the loan out of its own sales. 2 restructurings in 2023 converted roughly $660 million of it into equity. Neither was enough. Hold that thought, because it is the same shape as everything else in this story. The revenue line tells it faster than the legal paperwork does. $690,100,000 in 2025, down about 8% from nearly $750 million the year before. West Marine does not sell boats. It sells the parts, the paint, the lines, and the electronics to people who already own one and are still spending money on it. Debt explains why the company could not absorb a bad year. It does not explain why the year was bad. An 8% drop in parts spending in a country where the boats are already in the water tells you something narrower than a sales slump. It tells you people stopped maintaining. Remember that word, maintaining. It comes back later, and when it does, it explains a number the marine business would rather you never look at. Then there is the factory side. Group Beneteau runs a plant in Cadillac, Michigan through its American arm, Wreck Boat Holdings. That plant builds 4 Winds, Glastron, and Scarab. In 2022, it built 2,313 boats. Last year, it built 474. In 3 years, that plant lost roughly 80% of its output. The company put the operating losses on those brands at roughly $34,200,000 across 2024 and 2025. Orders for 2026 are running down nearly 30% against last year. Production stops this quarter. 232 people lose their jobs, and the brands are on the block looking for a buyer. It is not one company either. Bass Pro shut its Tracker Marine plant in Miami, Oklahoma at the start of last year and let 148 people go, blaming the downturn and the double hit of higher rates and inflation. Catalina Yachts, the biggest builder of mid-size sailboats in the country, paused operations after 56 years. So the factories are going dark, the parts retailer is in bankruptcy court, and the dealer chains are being liquidated. 3 different parts of the same business, all failing at the same time, all pointing at the same thing. They are not failing because Americans stopped liking boats. 85 million people still go boating every year in this country. The outdoor recreation economy it belongs to was valued at $1.2 trillion, about 2.3% of American gross domestic product. Demand did not vanish. What broke was the money. And to understand how it broke, you need to know something about the boat you bought that your dealer had no reason to explain. That boat was financed twice. Not by you and by the dealer on 2 completely separate loans secured against the same hull at the same time. The dealer's loan is called floor plan financing. It is a revolving credit line, usually from a bank, that a dealer uses to buy boats from the manufacturer and park them on the lot. The dealer does not own that inventory outright. The bank does. Every boat sitting under those flags in the lot is collateral on a loan, and the dealer pays interest on it every single month it does not sell. When rates were near zero, that cost was almost nothing. A dealer could sit on a boat for a year and barely feel it. When rates climbed, the same boat started costing hundreds of dollars a month just to exist on the lot. Multiply that by 200 boats, then multiply it by a slow season. That is exactly what took down Tommy's Boats. Tommy's was not a small operation. 14 dealerships in 8 states, $190,200,000 in revenue in its 2023 fiscal year. It was the largest wake boat dealer group in the country, and it sold so many Malibu boats that it accounted for about a third of Malibu's entire powerboat sales category. In April of 2024, M&T Bank went to a Michigan court and said Tommy's had defaulted on nearly $118 million in principal and interest on its floor plan agreements. The bank asked for a receiver. Weeks later, Tommy's and 16 affiliated companies filed for Chapter 11 in the Northern District of Texas, listing liabilities between $100 million and $500 million against assets of $10 million or less. 9 days after the bank moved, and 6 weeks before the bankruptcy filing, Tommy's sued Malibu Boats. The complaint alleged the manufacturer had pushed nearly $100 million of its highest-priced, slowest-moving inventory into 15 Tommy's dealerships to prop up its own reported sales numbers during an obvious downturn. Those allegations were never tested in front of a jury. The case settled for $3.5 million. The court appointed a trustee, the chain was carved up and sold, and the liquidation plan went into effect on August 26th of last year. Customers who had put deposits down on boats that were never delivered were told, in writing, that the bank was likely to come up short even after every asset was sold, and that there was no assurance they would see anything at all. That is the first layer of the answer. When a dealer chain defaults on floor plan debt, the bank does not carefully market those boats to protect anybody's resale value. It moves them fast. Hundreds of nearly new boats hit the market at whatever price clears them, and every one of those sales becomes a comparable that an appraiser will use against your boat. You did not sign anything, you did not miss a payment, and your boat lost value anyway because a bank in another state needed to close a file. There is an entire industry built to move that inventory quietly, and it has been running for decades. 79% of the lenders in the Marine Survey use third-party liquidators, not brokers and not dealer lots, to remarket the boats they take back. One firm in Fort Lauderdale has handled more than 40,000 cases since 1988, a mix of bank repossessions, foreclosures, and government seizures. A liquidator is paid to clear the file inside a set window. Inspection is on the buyer, and it costs extra, so plenty of these boats change hands without anyone hauling them out or running them, and without anyone asking what the thing was worth 18 months earlier. Whatever price clears becomes the market's memory, and it does not wash out. Nobody watched this part of the industry when it mattered. Through 2020 and 2021, everyone told the same story about waiting lists, sold-out model years and dealers with nothing left on the lot. All of it true. All of it the setup. That buying surge carried the market into 2022 and pulled a lot of first-time owners onto the water. Dealers who had spent a decade staying careful about inventory started ordering ahead, because ordering ahead bought them something to sell. Then the tide went out on cheap money, and every one of those decisions turned into a bill. Look at where the market actually sits now. On a rolling 12-month basis through February of this year, new powerboat retail unit sales fell 8.8% to 214,115 units. Through January, the same measure was down 9%. Pontoons dropped 13%. Personal watercraft fell 10%. Stern drive boats had already fallen 20% in the previous stretch. Jet boats fell more than 14%. Now, your side of it, the retail loan. The average new boat runs around $42,000, and the typical buyer puts 10% down and finances the rest. Boat loan rates in 2026 generally run between 7 and 10% for well-qualified borrowers, with weaker credit pushing into the double digits. And boat loans are long. 10 to 20 years is standard. Some lenders write 252 months, which is 21 years. Run that out. On a 20-year term at a 10% rate, a borrower pays more in interest over the life of the loan than the boat cost in the first place. That interest is front-loaded, so in the first years, the great majority of every payment is buying nothing but time. Meanwhile, the boat is losing value on its own schedule, and that schedule is unforgiving. A pontoon typically drops 25 to 30% in the first year or two. A new boat can shed several $1,000s the moment it comes off the lot. So you have a 20-year loan paying down slowly against an asset that loses a quarter of its value in 24 months. The borrower is upside down almost immediately and stays upside down for years. Nothing has gone wrong at that point. That is the loan working exactly as it was written. But that only explains half of it. Because if the retail loan were really the problem, you would see it in the delinquency numbers. And you do not. The National Marine Lenders Association publishes an annual report on how marine loans are actually performing. It is the most detailed picture of boat lending that exists in this country, now in its 46th year. This year's edition, covering 2025, put marine loan delinquency at 1.42%. 1.42%. That is up from the year before, and it is still better than consumer installment loans as a whole. Gross yields on boat loan portfolios actually went up to 6.38%. Read that number cold and it says the boat lending market is fine. So how do you square a healthy delinquency rate against a bankrupt retailer, a shut factory line, and a liquidated dealer chain? Either that number is telling the truth and everything else is noise, or that number is measuring something other than what you think it is measuring. It is the second one, and the way it works is the most useful thing in this entire story. If this is the kind of thing you want to know before you sign anything, subscribe. This channel goes through the marine market with the actual filings and the actual numbers every week. Start with the size of the thing. 236,000. 70 new powerboats sold in 2024. 215,000. 237 in 2025. That is roughly 21,000 boats that did not get built, did not get shipped, and did not get financed in 12 months. Stack 3 of those years together, on top of an inventory pile bought at peak prices with borrowed money, and the arithmetic stops being gentle. And new boats are not even the main event. The pre-owned market accounts for roughly 80% of total annual unit sales in this country. 4 out of every 5 boats that change hands are used, which means the price of a used boat sets what every other boat in the country is worth, including yours. Now, to see what the delinquency rate is hiding, you have to look away from boats entirely, at the same households. In the third quarter of 2025, the share of American auto loans 60 or more days past due hit 1.68%. Federal Reserve Bank of Philadelphia research published this April flags that as the highest level since 2008. Among subprime borrowers, meaning credit scores at the lower end, the picture is worse. Fitch Ratings tracks 60-day delinquencies on subprime auto loans that have been bundled into bonds. In January of this year, that rate hit 6.90%. That is a record in a data series going back to the early 1990s. It eased slightly to 6.80% in February and stayed there. Prime borrowers, by comparison, are running around 0.42%. And even during the financial crisis, prime delinquency never got past about 0.9%. Repossession volume followed. 1.73 million vehicles were repossessed in a single year, the most since 2009. The lenders are already reacting. In the middle of this year, America's Car-Mart had to go back to its own lenders just to keep operating. And Credit Acceptance reported that the loans it wrote between 2021 and 2024 are underperforming what it expected. When a lender says its recent vintages are underperforming, that is the polite version of saying it priced the risk wrong. The response is always the same: tighter approvals, bigger down payments, shorter terms on older collateral, which lands directly on the person trying to sell a 10-year-old boat, because the buyer who would have financed it in 2022 cannot get approved for it in 2026. So here's the state of play. The car loan, the thing a person needs to keep their job, is going bad at rates not seen since the last financial crisis. And the boat loan, the loan on a toy, is supposedly performing better than average. That does not happen by accident. The full answer comes down to one habit, and it has nothing to do with credit. A boat is the first thing a household gives up, and giving it up almost never shows up as a delinquency. Think about the actual sequence when money gets tight. You do not stop paying the mortgage, you do not stop paying the car, because the car is how you get to work. You look at the 22-foot boat you have used 4 times this season, and you list it. Or you call the lender and arrange what the industry politely calls a voluntary surrender, sometimes a friendly repossession, where you hand the keys over before anyone has to come get them. Or you take a short sale at a loss and eat the difference. 2 of those 3 roads never generate a 60-day late payment at all, and the third one usually ends before the count gets that far. The account closes, or the balance transfers, or the collateral moves, and the loan quietly leaves the pool that the delinquency rate is measured against. There is a second reason that number sits low, and the same survey series has been showing it for years. Marine lenders write to a narrow slice of the country. The overwhelming majority underwrite at credit scores of 700 and above. The dominant borrower age group runs 45 to 54, and the income concentration sits in the 6-figure tiers. That gives them the cleanest pool in consumer lending, and a clean pool produces a clean delinquency number almost regardless of what the collateral is doing. That number reads the borrower rather than the boat. The distress is real, it just does not land in the delinquency column, it lands in the price column. Every quiet surrender, every panic listing, every bank-driven liquidation of a defaulted dealer's stock lands as another cheap comparable in the database an appraiser opens when it is your turn. Which is why the parts number mattered earlier. People stop buying paint and filters once they have decided they are not keeping the boat, months before the listing ever goes up. The retailer sees the exit before the lender does. The delinquency rate is not a smoke alarm. It is a receipt written after the fire. And the moment it happens looks smaller than you would expect. Usually the storage invoice lands in the same week as the insurance renewal and a quote for a lower unit rebuild on a boat that got used 4 times. Nobody there has run out of money. They have just run out of patience, and they never show up in any statistic about distress. Their boat shows up on the market instead, priced to move, next to yours. So who wins and who loses? The dealers who leveraged hardest lose first and lose completely. The manufacturers who pushed inventory to protect a quarterly number lose next. The banks mostly do not lose. When a boat is repossessed and sold for less than the balance, the leftover amount does not disappear. It is called a deficiency balance, and in most states, the lender can still pursue the borrower for it. A person can lose the boat and still owe money on a boat they no longer have. The owner who bought between 2021 and 2023 loses the most. Peak pricing, long loan, and negative equity in a market being repriced by forced sales they had nothing to do with. And then there is the buyer with cash and patience, who is about to have the best 2 years of leverage this market has offered since the last downturn. Every one of those forced sales is somebody's entry price. Here is the number to use this week. Before you make any offer, pull 3 sold prices, not asking prices, on the exact model and year you want, from a dealer or broker who can see closed transactions rather than listings. Then subtract 10% of the boat's value for first-year repairs and commissioning. That is the rule I work to, because on a boat that sat through a soft market, deferred maintenance is the norm rather than the exception. That figure, sold comparables minus 10%, is your ceiling and it is yours rather than the asking price or the appraisal. And ask the seller one question first. How long has it been listed? If the answer is over 90 days, you are not negotiating against them anymore. You are negotiating against their payment. Everything I use to run those numbers is in the complete boat buying guide. It walks the sold comparable pull, the survey checklist, and the repair math, so you are not guessing at that 10%. $27 at fleetwatchmanual.com. There is one more piece to this. Look at what is hanging off the transom of the cheapest boats coming into this market, and where those outboards are actually built. What that is doing to resale values is a story on its own, and it is on screen now.